Borrow until you die sounds like the ultimate rich person money trick. Own assets, borrow against them, avoid selling, and let wealth keep growing. But the part most videos leave out is that this strategy is not powered by debt. It is powered by collateral, cash flow, tax planning, and the ability to survive bad timing. Copy the borrowing without the protections, and the same strategy can backfire fast. By the end of this audit, you will understand how it actually works, why wealthy people use it, and the rule of thumb you need before copying any advanced financial strategy. First, we will break down the mechanics of the high net worth borrowing model and remove the illusion of free money. Second, we will expose the 4 hidden structural requirements financial videos usually leave out. Third, we will examine where normal households turn an advanced wealth tool into a cash flow trap. Most people miss the difference between the visible tactic and the invisible balance sheet. The rich borrow with options. Normal people often borrow with pressure. If you do not know which one you are doing, you are not planning, you are gambling. In advanced personal finance, borrow until you die refers to an asset-backed lending strategy. A person builds or inherits valuable assets such as stocks, real estate, or business equity. Instead of selling assets when cash is needed, they borrow against them. The lender issues a loan secured by collateral, while the original assets remain invested and potentially continue growing. Because loans are generally not treated the same way as earned income or realized gains, the borrower may delay a taxable event. The goal is not to avoid payment forever. The goal is to control timing. Delayed does not mean deleted. Borrowed money does not mean free money. Every loan creates a real liability and attaches an interest rate to the balance sheet. Interest accumulates every day. This is not magic. It is timing. In many high net worth situations, the debt may ultimately be settled through estate assets after death, depending on applicable laws and planning structures. But until that day arrives, the debt is real, the liability is real, and the oversight must be constant. The human brain loves shortcuts. When people hear that wealthy individuals use debt to fund their lifestyles, they focus on the visible borrowing and assume debt itself is the secret. That is the mistake. The strategy appeals because it appears to bypass friction. It suggests you can spend money without shrinking your assets and without paying taxes immediately. But debt is dangerous when it is your only option. Debt becomes flexible when you have many options. The hidden system behind the borrowing matters far more than the borrowing itself. The wealthy are not winning because they take loans. They receive favorable borrowing terms because they already own large liquid assets that lenders want as collateral. Banks view portfolios differently than paychecks. Jobs can disappear, markets fluctuate, but collateral can often be seized. Wealthy borrowers also have teams managing taxes, cash flow, risk, and estate planning. They have multiple backup liquidity sources. The average person trying to copy the move with a paycheck, mortgage, and thin emergency fund is playing a completely different game. The first requirement is collateral that lenders actually trust. That means assets that are liquid, easy to value, and easy to sell. Lenders do not care about your future potential or optimism. They want assets they can liquidate if things go wrong. Wealth tied up in illiquid property, speculative investments, or niche assets is not the same as a diversified liquid portfolio. The strategy is powered by collateral. Without strong collateral, interest rates rise, loan terms tighten, and the margin of safety disappears. The second requirement is independent cash flow. Loans are not gifts. Interest must be serviced. If assets slow down, fall in value, or underperform the borrowing cost, debt begins consuming equity. Wealthy users of this strategy often have businesses, rental income, distributions, or other stable cash flow sources supporting the debt. They are not relying entirely on asset appreciation. The interest must remain manageable even when the underlying assets are struggling. That separation is critical. The third requirement is a large margin for bad timing. Markets fall. Interest rates rise. Credit conditions tighten. If you borrow heavily against a portfolio and the market drops, lenders can issue margin calls. If you do not have outside liquidity, assets may be sold at the worst possible moment. Wealthy borrowers survive because they usually borrow a small fraction of total asset value and maintain large cushions. Normal borrowers often stretch closer to the limit because the payments seem manageable today. The fourth requirement is ongoing tax planning. The relationship between debt, capital gains, asset growth, estate transfers, and tax law is complex. Rules change. State regulations vary. Interpretations evolve. What works under one system may become less effective later. This is not a set-it-and-forget-it strategy. Wealthy households maintain teams of professionals who adjust structures as laws change. They do not simply use the tactic, they maintain the system around the tactic. Normal households often copy the visible behavior instead of the invisible structure. They see wealthy people using debt to optimize wealth and then use debt to fund lifestyles. The trap is not borrowing. The trap is needing everything to go right. When leverage depends on rising asset values, stable income, low interest rates, and perfect timing, the system becomes fragile. A liquidity tool slowly transforms into an anchor. Consider a homeowner whose property value rises for several years. Feeling wealthier, they open a home equity line of credit and pull money out for lifestyle spending or speculative investments. They believe they are unlocking wealth like the rich, but they have attached variable rate debt to their primary shelter. If housing weakens, income drops, or interest rates rise, the debt remains. The payment remains. The bank still expects repayment. What looked sophisticated online becomes pressure in real life. The same mistake appears in brokerage accounts. An investor builds a portfolio and then borrows against it to fund purchases or lifestyle upgrades. The setup feels harmless because markets have been rising. But the structure only works if several conditions remain favorable at once. If markets decline, the lender can liquidate shares to protect itself. Years of disciplined saving can be damaged by a single leverage decision made during a period of optimism. Financial media often packages these strategies with headlines claiming the IRS hates them or that banks are hiding secrets. The goal is to make the tactic feel forbidden and exclusive. But the real question is not whether the strategy reduces taxes. The real question is whether your financial life can survive it. Tax efficiency means very little if leverage destroys liquidity, triggers forced sales, or removes your control over timing. A strategy can be tax efficient and still be financially fragile. Saving money on taxes does not help if interest costs exceed investment growth. Avoiding a taxable event means little if you lose control of your assets during a downturn. Wealthy families use these structures inside diversified systems designed to manage risk across generations. When consumers copy them without the same framework, they are accepting institutional-level risk with retail-level resources. Never borrow against an asset unless you are willing and able to watch that asset decline sharply without triggering a forced sale. During bull markets, everything feels safe, but assets can fall dramatically. Review your accounts in dollar terms, not percentages. If a severe drop would cause panic, missed payments, or liquidation pressure, the debt is probably too large for your situation. Never rely on future asset growth to cover debt costs. Every dollar of interest should be manageable from current stable income. Review your monthly income, expenses, and uncommitted cash flow. If a new loan creates interest payments that require market performance to survive, you are introducing unnecessary fragility. Debt should be supportable even during poor investment performance. Do not keep all wealth trapped inside illiquid assets while relying on debt for liquidity. Maintain cash reserves capable of eliminating smaller debt balances immediately if credit conditions tighten. Cash may feel inefficient during good times, but liquidity becomes priceless when markets become unstable. The reserve is not for lifestyle upgrades. It is protection against panic. Do not copy the tactical moves of wealthy individuals. Study the principles behind those moves. If a billionaire borrows against assets, ask what hidden requirements make the strategy safe. Instead of copying a product, identify the core objective. Often the real principle is stability, flexibility, liquidity, or risk reduction. Understanding the system matters more than copying the tactic. The real secret behind borrow until you die has almost nothing to do with borrowing. Wealthy people are not successful because they have access to debt. They have access to debt because they already built strong balance sheets. This is not primarily an income problem, it is a system problem. Leverage amplifies whatever already exists. Strong systems become stronger. Fragile systems become more fragile. If your budget already depends on perfect timing, leverage makes it worse. If your cash flow feels tight, leverage makes it tighter. If your emergency fund is thin, leverage turns small surprises into major decisions. The lesson is not to maximize borrowing. The lesson is to build a balance sheet strong enough that bad timing does not control your future. Real financial power comes from autonomy. When you build collateral, liquidity buffers, and margins of safety, you create options. Options allow you to wait, say no, survive downturns, and maintain control. Borrowing without options is not strategy. It is dependency with better branding. In personal finance, flexibility often matters more than sophistication. Advanced wealth strategies look simple from the outside but rely on invisible structural pillars. Copying the strategy without building those pillars first can create significant risk. Rich people borrow with options. Many households borrow with pressure. Focus on what you can control: savings, liquidity, manageable expenses, and cash flow resilience. Financial success is not about finding better tricks. It is about creating more room for mistakes. This week, audit one wealth strategy you admire and list the hidden requirements necessary for it to work safely. This month, review every line of credit, loan feature, and debt obligation attached to your accounts. Calculate your vulnerability if income or asset values fall sharply. This year, prioritize liquidity and independent cash flow over speculative leverage. Avoid situations where everything must go right just to survive. For today's discussion, consider this question. What would scare you most about borrowing against your own assets? Rising interest rates, sudden asset declines, complicated tax rules, or losing control of your timing? The answer often reveals where your balance sheet is most vulnerable. Share your response and examine the real risk instead of the marketing story.